The Feds dropped mortgage rates today. Mortgage rates dropped today. Anyways, I know a lot of people have been waiting to hear that, and it sounds great, and I love it, but we can't wait on mortgage rates to drop. We just can't. Now, we have to move forward without that, and we have to make sure that we don't expect it. I know the borrowers are expecting it, consumers are expecting it, they're waiting. Again, if we go after our consumers, if we generate our own business and our own leads, we control the market. We control our own pipeline and our own business. That's what we have to do all the time. Good rates, bad rates, good market, bad market. It doesn't matter. We have to make sure that we go out there and we get it all the time. If you do that, you're always going to have a pipeline. There's always going to be somebody that needs something. Okay, debt consolidation right now. I know a lot of people doing second mortgages, Helocs, things like that. Why? Because this is the most consumer debt we've ever had in the nation. Bottom line, there's been hundreds of millions of dollars of free publicity every time news medias and the government, everybody talks about it and reports on it. That's free marketing. So that's what we have to target. You might not want to do them, but we got to do a mortgage. A mortgage is a mortgage is a mortgage. Doesn't matter if it's a purchase mortgage. A lot of people have been doing purchases. I've consulted and have a lot of students that are real estate agents and worked with a couple companies that's all we were focusing on. Great. So, but even more purchase mortgages, same thing. They're rate based because they can't qualify for the same home. They can't sell their last home because the amount of money that they're going to get, they're not going to be able to replace the house, blah, blah, blah. So in the mortgage side of it, we have to be able to make sure that we get and go after mortgages no matter what it is. Debt consolidation, home, cash out refinance, regular refinance, whatever it is. We just have to go after it. We can't be so rate based. Now that's a tough thing to overcome, right? Not really. It's just we have to overcome it. It's something that we have to acknowledge. We can't fake it. We can't lie about it. When I first got into the business, I had to upsell interest rates. I had to sell my customers the only product I had at the moment. When I first started, I only had the 125 second. That's all I had. I didn't know the business. I just got into the business. That was my first introduction to the mortgage industry. So I had to sell whatever I had. And I sold the shit out of it. Okay. And they're good products. The 125 mortgage was a good product. It succeeded on Wall Street. The bond market did great. It was the least amount of foreclosures. It was the least amount of defaults. It was the least amount of delinquencies. It performed really well. I know in theory, when somebody gets into a situation, yeah, if you have a 125, it's going to be harder to get out of a situation. It's going to look bad. But the reality is most people, that wasn't the case. But my point is that we have to get out of rate selling. Okay. But I used to have to increase somebody's rate, sometimes by 2 or 3%, but I'm saving them $1,200, $1,400 a month, especially nowadays. Interest rates on credit cards, on good credit. I got 800 credit scores, and some of my cards are almost 30%. And I haven't closed some of my accounts because I don't want to affect my credit, right? I don't want to close credit lines, but I'm always negotiating my rates. I need a lower rate. I'm going to leave, and I don't want to get too many credit cards and leave because, we know the system, as far as our credit goes. My point is that I know people out there are paying high 20s. So we're going to be able to get them savings pretty quickly. I don't care if we have to increase their rate from what they got 2 years ago, 3 years ago by 2%. So what? What do I care and what do they care if their rate goes up by 2%? If we're saving them $1,200 a month, they're already spending the $1,200 extra a month. They're not paying down any of their principal of their credit card. They're paying interest, mostly interest, 25, 26% interest, non-tax deductible, not fixed. We gotta, so if somebody's rate goes up by 2%, but I'm saving them $1,200 a month, it's a no-brainer. It's a no-brainer. And that's what we have to sell. Oh, but my rate's going up 2%. Yeah, but your monthly payments are going down $1,200. That's how much, it's like getting a $1,200 raise, and that's net. In order to make $1,200, you have to gross about $1,800. So an extra $1,200 net in your pocket goes a long way. And if you didn't need the money, you wouldn't have charged up your credit cards. You charged up your credit cards because you needed extra money. And the reason you haven't paid on your credit card sooner is because you don't have the extra money to do that with. So this is what $1,200 a month savings is huge. So don't worry about the rates. Yes, it's nice when rates go down. We're going to hit this next mortgage boom. It's coming. It's coming. But the reality is, the rates, we need to make money and we need to help people regardless of the rates. So regardless of what the market's doing, somebody's buying, selling, needing refinance, needing cash out, needing whatever, needing to consolidate their credit cards, pay for their kids' college, whatever the case is, there's something out there that we could do, but we got to go after it. And again, when rates dropped, I'm talking to a lot of people, a lot of my students like, okay, did your pipeline change? Are you closing more? A couple are. So I know it affects it, but we all know that when the Fed lowers the interest rate, it's not like it just drops automatically for the mortgage industry, right? But I know a lot of banks and stuff, they've been doing their own stuff. They've been doing their own calculations. They weren't anticipating the rate drop. So they kind of dropped the rates about a month or two ago. So that's the thing, is when we know that rates are going to drop, or that's what's expected, the bankers, they drop the rates anyways. And then a lot of times consumers, that's why we got to go after people. We got to go after the people that were waiting on it in our pipeline that we didn't close, or people that, whatever, on the fence or our old database, whatever the case is, or just new marketing. And we got to know that when the feds drop the mortgage rates, that's already in the rears. We should have been on it a month or two ago. So a lot of times we didn't focus on the marketing or chasing it a month or two ago. And people are waiting, consumers are waiting for it to go down. And that's what we have to explain to our customers. Hey, listen, the feds are expecting to drop the rates, but the banks have already anticipated that. So banks have already adjusted for that. That's why a lot of times also when you wait till the rates drop, now you're behind the game. You're behind. So now when consumers say, hey, hold on, that's the same rate you quoted me last month. Didn't the feds just drop the rates? Yeah, but the banks adjusted for that a month ago. So we have to be able to explain that, but we got to go after it. And it doesn't matter. Okay, we have to express savings. That's what we're selling. We're not selling rates. Sometimes in a rate and term market, of course you're selling rates. I'm giving you a 2% rate. I'm giving you a 2.5% rate. Oh, we're going from 2.5 to 2.5. You're getting whatever the case is, right? So we're not really rate selling in this market. So forget about the times of the rate selling. And people don't know rates. You don't know rates. I'll prove it to you. You think you know rates? Okay, let's see. What is the payment on a $636,000 loan, home mortgage, with a 6% rate? Tell me real quick. Don't use a calculator. Just tell me off the top of your head. Can't tell me, right? Okay, let me make it easier. On a $250,000 mortgage, what is the payment if the rate is 4.75? Tell me real quick. Okay, can't tell me. So now, what's the savings on the same ones? If it's a $636,000 mortgage at 6% rate, let's say, and then you have another $450,000 mortgage at 5%, what's the payments on either one? You can't tell me. But now tell me on which one of those is their savings. Because on the 6%, if I'm saving somebody $1,500 a month, and on the 4%, I'm only saving $100 a month, which one's going to sell? Which one can I sell? Which one makes more sense for the customer? That's what we have to focus on. So don't tell me you know rates, and don't tell me customers know rates. Because when a customer talks to me rates, I'm like, oh, really? So what's the payment on, if you were to drop your interest rate by 1%, which it's not going to happen at this moment. We're going to have to wait for that. But what's the payment if we drop it at 1%? They don't know. They don't know rates. Neither do you. So we have to do the calculations. And again, when the rates are dropping and somebody wants to wait, it's like, we got to capitalize now. Because at least I could get, even if I'm just doing a rate and term, I could save somebody $180 a month. Hey, I'm saving you $180 a month. I'm saving you, over $2,000 a year. That's net. Okay. Now we could get that savings now, and until rates drop next year, now all of a sudden we might be able to save a little bit more, but the rates might drop 0.5%, 50 bips in a year. So you're going to miss out on $2,000 worth of savings going back into your pocket. Oh, but the closing cost, this, that, or the other. We have to figure it out. Sometimes we might be able to negotiate. I'd rather take a lower paying commission than no commission. So then we have to work some things out sometimes. Or there's a lot of different options. We're not going to go over all of that now. But the reality is, stop selling rates. In this market, you can't sell rates. Okay, the only rate you could sell is, I'm going to get you out of that 28% rate. I'm going to get you down to 6%. And I'm going to get you out from a compounded daily interest rate into a fixed rate that's tax deductible. So if you're gonna sell rates, sell the fact that you're gonna get them out of that 28% rate. Oh, I don't want to this, that, or the other. You're already paying it. You're already paying 28%. I could get you 6%. So that's the comparison that we need to have. But the rates dropping and the feds and all that, yeah, it's free marketing. It's hundreds of millions of dollars of free marketing that we should capitalize on. Yeah, the feds did drop rates, and they educate them. And here's the best rate I can get you. Here's the rate that we got you qualified for and approved. And the reason for this, but this and that. Oh, but okay, well, banks already anticipated that the rates were going to drop because the Fed dropped it a quarter, and the rates actually dropped a quarter a month and a half ago. So that's why they were about even Steven. Now, some banks are competing a little bit stronger, and you might have a little bit different discrepancy, but it's not going to be that much. But the reality is, regardless of that, here's what we can get you. Here's what I can save you. Do a buy down. I mean, I'm not going to give you all the strategies of what to do, but, buy the rate down by a quarter. Do a small little buy down, whatever the case. There's so many different options that we could do, but the reality is savings, and getting somebody from the 20% compounded interest to something smaller, it's a no-brainer all day long. I don't care if the rate's 7%. Savings. If you're saving somebody $1,500 a month, that might be the difference between foreclosure and not. That might be the difference between being late on a mortgage payment or two or not. That might be the difference of being late on credit card payments or not. People are overextended on their credit cards because they don't have the money. And the credit cards is a catch-22. They use the credit cards, now they have less money. So, but we need to help them and make sure that they're able to qualify still for a mortgage, especially if they're desperate. We got to educate them and say, hey, listen, you're cutting it pretty close. You're pretty tight at the end of the month. There's not enough cash at the end of the month to cover your bills. You're only one mistake, one, transmission away from not being able to make some payments. So if something were to happen drastically in your life, you're in trouble. You're going to end up maxing out your credit cards, or they might be maxed out already, which is also hurting your credit scores. We need to get you back on track so then when the rates drop even better, we're in a position to be able to capitalize on that as well. Don't be so focused on rates. Don't be a rate seller. In this market, we can't, except the rates that we're talking about selling is dropping their credit card rates.